So today we're going to be looking at planning for in the final year before a lot of these TCJA Act expires. So we'll be looking on why is 2025 a pivotal year for tax planning. As I mentioned before, many provisions from the Tax Cuts and Jobs Act are set to expire after December 31st, 2025. So let's take a look at what is at stake. So we're going to be needing to plan amid uncertainty because, again, many of these provisions that are set to sunset could, if Congress does something this year, be extended. Okay, but we don't know. So all we can do is work with the best information that we have at the time, the current tax law that we have at the time. So those individual rate cuts, they may expire. So those individual tax rates are going to revert to the 2017 levels. So right now, our top individual income tax rate is at 37%. Well, the top rate before that was 39.6%. So they're going to go up if nothing is done. The standard deduction is going to shrink significantly. However, personal exemptions may return. So the standard deduction almost doubled. So that might shrink. Then we have the estate and gift tax exemptions, which are currently over 13 million. They could drop to about 6 million. So that's another big change, almost, half again. And then the qualified business income deduction, that's a pass-through entity, that's going to expire as well. So 2025 really is the last year to act under today's favorable tax rules. So let's go looking at the next is when we're looking at those planning amid kind of that uncertainty, what should we be doing? We might want to encourage our clients to accelerate income into 2025. So when we're looking at the tax rates going up, we may want accelerated income now. We also have those high gift estate exclusions while they last. That's a little bit difficult. We do not like to time when people pass away. So hopefully Congress will do something about that. Maybe the capital gains are going to increase. So we might want to harvest those capital gains now to avoid potentially paying higher rates later. Also, look at the reviewing the business structures for the pass-through advantages before they go away. So we may accelerate the deductions for corporations, and what that means is that some of these R&D, Section 179, some of these deductions were increased at different levels for the TCJA Act, and they've been phased going out. Reduced percentage lower and lower each year. So maybe at one point our section 179 was 100%, then maybe it goes down to 80, then maybe it goes to 60, 40, 20, and then 0. So you may want to accelerate some deductions before they go away. But we also might want to accelerate income. If we are a pass-through entity using that qualified business income deduction, we may want to accelerate our income into 2025 when we can get a 20% deduction on it on our individual return. So it all depends on what is the client specific situation. So again, even though Congress makes then some or all of these provisions, as the law as written today says they're going to expire. So smart planning means we've got to work with what we know today, not what could happen, right? All right, your case study this week is going to give you a chance to apply these mindsets to two real world clients.